So if you've been looking to purchase a property, it should be no surprise to you that rates are high and home prices are high, but thankfully there are some hacks that can be done to get your mortgage payments lower. So today I wanted to go over a few different options that could potentially work for you as a buyer to get your mortgage rate even lower. Right now, the mortgage industry is getting hit hard because there's not a lot of trading going on between buying and selling homes. So they're coming out with new products for buyers to intrigue them to jump into this real estate market, especially because we've been seeing rates climb. So today I wanted to go over a few different options that you could potentially take and see if they are good fit for you. So you can look at a rate buy down. You can pay points to buy down your rate. So let's say you are quoted at an 8% interest rate and you pay points to buy down that rate all the way down to, let's say, 7% mortgage rate. And just depending on what your lender is asking for in points, that will be how much you need to pay. So typically a point is 1% of what you are being lent on the purchase price of that property. And here's a little hack for buyers. If you're in contract or writing an offer, you can ask the seller for credits to buy down your rate. Now, this doesn't mean that the seller is going to agree to you asking to buy down your rate, but potentially instead of repairs, if the math makes sense, you can ask for no repairs and a rate buy down. But there is a caveat when it comes to buying down your rate. You need to figure out how long you will be in that property and what your break even point is. Because if you're paying the lump sum up front and you're only planning on being in the property, let's say 2-3 years, then buying down your rate might not be the best choice for you. But when talking to a mortgage lender, you want to ask about a rate buy down. Now let's talk about ARMs. So what are ARMs? ARMs are adjustable rates. So you can get an ARM that's locked in from 1, 3, 5, all the way up to 10 years with a fixed rate. But after that time period, your mortgage rate adjusts to whichever rate you agreed upon, and depending on where mortgage rates are at that time. Now, typically, if you're getting into an ARM, you're hoping that in the future, you're gonna see interest rates come down. So you're somewhat gambling, and that's why I wanna make sure that if you have a lender who's trying to get you a 1 to 3, 5, 10-year ARM, that you completely understand the math behind the ARM and that you're not getting suckered into a loan that you're not sure about. Because you need to make sure if you're getting an ARM that you can actually afford the higher interest rate. Worst case scenario, let's just say you got a fixed rate at 7.5% and this ARM after 5 years adjust to 8.5%. Well, when you get that ARM, you need to make sure that you can pay that 8.5% right now, because worst case scenario, that ARM, the adjustable rate goes back up to 8.5% and you can't afford it. The last thing you want to do is have to walk away and potentially default on your loan. Especially right now in a volatile market, you don't know if interest rates will continue to go up and what home prices are going to do. And obviously, worst case scenario, let's just say after that ARM adjusts in 3 years, home prices have calmed down and you can't refinance into a 30-year fixed because you don't have any equity, or maybe you lost your job. Well, then now you're in an extremely tough position where you have a mortgage rate you can't afford, when just 3 years ago or 5 years ago you thought you can afford that payment. So to me, I think ARMs are risky unless you have bought in a home before and you completely understand what you're getting yourself into. But I want to make it very clear, you should definitely go over this option with your mortgage lender and make sure they explain it thoroughly, and make sure you as a home buyer completely understand your own personal finances. So one thing as a real estate agent that I've been hearing a lot lately, especially with these higher mortgage rates, is date the rate and marry the house. Well, what happens when mortgage rates continue to climb or they stay this high for longer than we expect them to? Because again, everyone's coming out with their own predictions, but they don't know what's actually going to happen with mortgage rates. So to sum up, there are some options for buyers out there to make the mortgage payments lower and get in this real estate market while interest rates are a little bit higher than what we're used to. But with that being said, you just need to go over your personal finances and remember that your lender only is going to qualify you to the maximum amount, and sometimes they don't thoroughly go over what an ARM is, and you just need to make sure as a home buyer that you cover your bases and understand the math behind adjustable rate mortgages and potentially getting a rate buy down. So anyways, let me know if you have any questions, and if you're looking to purchase a house, let me know in the comments. Let's get some conversations going. I hope you like this video, and I'll see you in the next one.